In theory, it is not necessary to have a cash flow statement, as all cash items could be recorded on the balance sheet directly. However, in practice, that is not practical, and only the closing cash balance is shown on the balance sheet, while all other details are shown on the cash flow statement. Understanding where cash comes from and how it is being used is very important for managers of the business, for financial analysts, and for other users of the financial statements. The cash flow statement organizes cash inflows and outflows into three categories. The first is operating activities. The second one is investing activities. And the third one is financing activities. Let's take a closer look now at cash flow from operating activities. This includes items that are found on the income statement, such as revenue and operating expenses. However, it only includes them if the cash payment actually occurred in that period. So, for example, it just includes revenue that the company has actually received the cash for, and it just includes expenses that the company has paid out the cash for. So, it's similar to the income statement or statement of operations in that it reflects revenues and expenses from the period, but it's different in that it only reflects them if actual cash movements occurred during the period. Now let's take a closer look at the cash flow from investing activities. Investing activities include things like purchasing property, plant, and equipment, or selling those assets, as well as making investments in other businesses, or acquiring or divesting of entire businesses. This is where a company records its capital expenditures as well as M&A activity. If we take the cash flow from operating activities and we add the cash flow relating to investing activities, then we arrive at the net cash flow before financing activities. The final category on the cash flow statement is cash flow related to financing activities. This is very distinctly different from operating and investing activities. This includes things like issuing shares, raising new debt, repurchasing shares or repaying debt, as well as paying dividends. Finally, if we take the cash flow from operating activities, add the cash flow from investing activities, and add the cash flow from financing activities, then we finally arrive at the net cash movement over the period. This is the total change in cash position for the company.